Hey guys, stock Saturday, and I'm up £2,000, so underperforming the market again. As long as the S&P and Nasdaq continue going up, then I would imagine I'm going to underperform. Got a few bits and pieces sort of on the up, but on the whole, I'm not in the sort of main stocks that are going up. Really, it's the fangs and sort of high tech side, really, and a little bit of semiconductors. So, hoping for a more sort of short term pain, long term gain scenario, I guess. I'm still more sort of bearish than most people. I don't think we've sort of seen the end of the downturn with sort of interest rates that they are. So, yeah, I'll carry on. Not a lot of earnings this week again, so I'm looking all at macro news at the moment. So let's go straight into the news, and then I'll go into sort of a little bit more detail on what stuck out to me. So there was quite a lot this week. We've had a bit of UK unemployment news, or not unemployment, as you can see. So claimants of unemployment benefits down, average earnings quite high, although people will see this as a bad thing, sort of wage price spiral contributing to CPI, high CPI numbers. Employment change was expected to sort of come down from the previous month, but still positive, sort of 150k, and that blew out at 250k, so 250,000 more jobs on a 3-month period. And unemployment was expected to rise, and that's come down again, so 3.8%. So UK looking pretty good, or the jobs market at least. Is sort of, again, worth pointing out that unemployment does tend to sort of drop into the beginning of a recession and then sort of spike sharply upwards. We do potentially seem to be just a little bit behind the US and sort of following the same path. And then you had Tuesday, the CPI numbers for the US, the day before the interest rate increase, so they didn't have a lot of time to go over it, and it was largely sort of on the important stuff. I would say the core CPI largely as expected, 5.3%, down a bit from previous. The monthly still at 0.4% though, same as last month, so the last 2 months, it's been sort of compounding at nearly 5%, sort of 4.9% CPI. So they want it at 2, and we're at 0.4. We're at 4.9. So not particularly good. Does sort of lend itself to the higher rates for longer idea. People will look at the sort of headline CPI coming down 0.1%, but this presumably is just energy and food, since the core is quite high. So they want that. They want shelter and wages and all sorts of things coming down, not just energy and food. But this month does make quite a big impact on the headline annual CPI. So again, 4.9% last month, down to now 4%. So almost a whole percentage knocked off that. People will be positive about. What else we got? UK GDP, that's a little bit old, but still positive. Not too bad. And then that was pretty much it until the end of the day. You had the Fed interest rate decision, which was basically seen as almost a certainty of a pause, and it was a pause, so fair enough. And yeah, the market sort of seemed to be fairly happy with that. Then Thursday you had the EU raise their rates 0.25%, again sort of all as expected, so no surprise, seems to mean positive sort of moves for the market. Everyone's sort of fairly happy with what's going on. Again, EU CPI, this is sort of already come out. The provisional figures were correct. So yeah, that was pretty much it for the news for the week. So the Fed rate obviously looks a bit more like a slowdown and a pause, judging by sort of this curve. But if you go on to the sort of longer term, you can see the previous sort of raise for in 2016, 2017 and 2018 obviously was a lot slower, and then they had to sort of sharply drop it again, remembering before COVID started. Things were going wrong already, and compared to this rise, it's still quite heavy, and we're up to sort of 5.25% now. So will be interesting to see sort of what comes of it. Everyone keeps reminding everyone of the lag that comes from raising rates. You know, just because things haven't broke yet doesn't mean everything is fine. And with the interest rate decision, you also get every other meeting the dot plot. So this is where all of the members, so not the average, this is where all of the members think interest rates are going to be at the end of each year. So each dot is a member. And yeah, looking at 2023, so the end of the year, it's hidden a little bit behind this this sort of key here. You have a couple of people, one person at 6.25% for the end of the year. That is rather sort of hawkish, as they say. It's a 1% rise for the end of the year, where people are expecting cuts. You've got a couple of two people at 6%. That would be 0.75% rise. Again, I guess they're looking at core CPI not really coming down. It's still basically at 4.9%, 5% annualised. And then, yeah, you've got the majority of people at 5.75%. So this would be a 0.5% increase. And yeah, 4 people at 5.5%, and then a couple at sort of 5.25 where we are now. So no one's expecting a cut from where we are now, and basically no one's expecting a pause. So that's interesting. Going against the market, market sort of seems to think maximum 0.25% increase from here for the end of the year, and a lot of people think we've already topped on rates. So still a divergence, and then you start to sort of get the idea that all of the members very much disagree with each other. You look at end of next year, you've got one person still at 6%, and sort of, so I guess those three are those three sort of expecting we'll need to keep rates high, and then all of the rest start to sort of diverge a fair bit, ranging from, you know, all the way down at 3.75 to sort of 5.25. But then 2025 is when it really gets silly. You've got presumably this top member still at 5.75% at the end of 2025. So 2.5 years away, rates will be higher than they are now. Can't really see that happening, and obviously he's way above all the rest. And you've got a huge sort of dispersion of people all the way down to 2.5%. And then you have this longer term sort of unchanged thing. They just, who knows what longer term is. But yeah, interesting to see sort of the Fed members going against basically the whole market, institutions and the general public and the bond market and everyone. But they're saying more rate rises to come. All of them, basically. As I was saying, this, I would think, is what they're partly looking at, to say that they haven't exactly broke the back of inflation. It was the sort of core inflation had a couple of big spikes in 2021, but people have only really been talking about it in 2022 sort of en masse, and it's really not come down all that much. Still at sort of 0.4, 0.4, 0.5, 0.4, and so far the rate rises have had sort of little effect. Obviously some of the rate rises in late 2022 you would think might have started kicking in by now, and yeah, they don't want it at, you know, 4.9% annualised. So as much as normal CPI is coming down, the core sort of isn't really that sort of on the annualised. Again, sort of trickling down 0.2%, 0.1% at a time, but I think they want it coming down quite a bit faster than this. So the again, the public and what sort of makes the headlines when these figures come out is the headline CPI, and you see that sort of falling off a cliff. And I guess this, as I say, is largely down to food and energy. So whether that will feed into the core CPI, sort of energy affecting, basically everything, we'll have to wait and see. But so far, it's not. And obviously, even 4%, they want it lower from here. But assuming it's going to come down, sort of with this trend, then yeah, it will be at 2% sort of before long. But yeah, they want the core down basically. And then an interesting effect this is having on the dollar, on the currency. So normally I would use the dollar index for this, but sort of seeing as it obviously affects our portfolios quite a bit, just looking at the pound dollar. So interesting sort of goings on in the pound at the moment with inflation and sort of our interest rate talks. We've been talking about sort of maybe having to raise another 1%, where I think people thought we would maybe pause with the US, if not maybe 0.25% rise. But yeah, they've been talking about 1% rate rise. So this sort of, I guess, hardens up the pound, and with a sort of weakening dollar at the moment, this does sort of have quite a stark effect on our portfolios, sort of from the lows in the US banking crisis issues. Yeah, you've now got these highs. So sort of as an example, Meta Platforms, our favourite Facebook holding, I believe was $274 back sort of a couple of weeks ago, and my position was up, including the FX impact. I believe I was up 50%. This doesn't show the FX impact. It's very small at the moment, but yeah, $274, and I was up 50%, and it's now 281. I thought I'll hang on for a little bit more, see if we can sort of get any more out of it. And obviously it's one of my only sort of FANG tech plays, other than a very small position in Google. But yeah, it's risen $7 from the 274, and I'm worse off. I believe it's 48% in my portfolio compared to 50%. So you're seeing a lot of stocks going up, but for us at least impacted by the pound. But it certainly has an effect on the portfolio in the short term. So yeah, I've got a few sort of holdings doing pretty well at the moment. Broadcom sort of up 7-8%. Glencore up 9% in the last week. Copper sort of really coming back into its own. Meta Platforms, as I say, up 6% in the last week, and yet I'm still sort of slightly worse off than a couple of weeks ago. Yeah, and sort of lots of other bits and pieces doing, 4%, 5% for the week, 3% some of them. Stellantis, 7% up for the week. That's doing really well, back above £10,000 as a holding for me. And TSMC certainly pushing it. Process pretty much at £10,000 as well. But yeah, not really a happy time in the ISA with the gold and silver stuff. That is, I guess, what is partly holding me back. Sylvania still dropping, sort of holding the just under 80p mark reasonably well, considering rhodium is sort of really down in the doldrums. I thought it might have dropped a bit further, but yeah, not doing too bad. Still got the treasuries, so I am sort of getting very close to selling some more of that and possibly putting into CleanSpark and the gold and silver miners. That's still my sort of my big bet for the next year and a half, 2.5 years, I would say. Not it's never a long-term bet, gold and silver. It's more of a sort of, as I say, a 1, 2, 3 year trade maximum. So yeah, that's what I'm looking to do shortly. Possibly the big trade would be filling the ISA by selling possibly the emerging markets ETF and meta platforms. That would give sort of pretty much all of the ISA for the year. Emerging markets is something that I'm still bullish on, and sort of long term would certainly get back into, but yeah, I just don't feel it's got as much sort of return potential as the miners and crypto miners. So temporarily, I would think I might be switching that out. And the IG ISA is sort of largely unchanged, just everything sort of coming down a little bit more. Pan American coming down, Clean Spark sort of down slightly, but again, sort of not looking to top that up here. That'll be topping up in Trading212. And Chinese tech sort of having a reasonably good couple of weeks, back up to 5.5. So, yeah, that's the portfolio for the week. Leave your thoughts in comments below and how you're doing. If you're presumably outperforming me with all this S&P and NASDAQ rise, and like and subscribe. See you soon.